esteemed industry leaders, our faculty members, Dean of SPJIMR, Professor Varun Nagraj, Chairperson of PGPM, who will soon join us, Professor Nilendra Singh Pawar, Associate Chairperson of PGPM, Professor Arindam Das, and all my dear friends. I, Ishan Deshpande, from the PGPM class of 2023, welcome you all to one of the most awaited events of the entire year. With a round of applause, let's begin with the Finance Conclave of Samavesh 2023. SP Jain Institute of Management and Research was established in 1981 under the Bharatiya Vidya Bhavan umbrella. SPJIMR's mission remains unchanged to influence managerial practice and promote value-based growth of students, alumni, organizations, their leaders, and society at large. SPJIMR is recognized globally as an innovative and socially conscious management institution. PGPM is an AICTE-approved 18-month program accredited by AACSB and AMBA with substantial work experience across varied domains such as engineering, history, economics, architecture, pure sciences, and merchant navy. The PGPM cohort brings in rich insights with the focus of design thinking and wise innovation in our ever-evolving pedagogy is what makes it stand apart. The program acts as a career accelerator for the candidates to get back into the industry as business leaders. Samavesh is the annual business academia conclave, which includes industry leaders and practitioners interacting with the PGPM participants in the form of guest lectures, presentations, and as we will soon have, panel discussions. Samavesh means inclusion. Samavesh is an event that we all look forward to, as it is one of the best opportunities for us as students to get an inside view of the concepts that we learn in class and how they are applied to solve real-world business challenges. We are all eager to get to know how the industry works and how we will apply what we have learned once we are back into the industry. Let me introduce you all to this year's theme for the Finance Conclave: Future Trends in Fintech, exploring the evolving landscape of financial technology and potential developments. The future of fintech in India is an exciting story. It is the story of technology and rules working together to make finance secure and better. Digital payments driven by government efforts like UPI and Aadhaar are growing fast, giving more people access to banking through digital wallets and mobile apps. Rules overseen by the Reserve Bank of India keep things safe while encouraging innovation through special sandbox areas for startups. Companies are using innovative ideas to make lending and banking better, especially for the people with lower incomes. Even in rural areas where it is hard to reach banks, fintech is making a difference with digital wallets and mobile insurance. Overall, fintech promises a more inclusive and empowered financial future for everyone in India. Now, please join me in welcoming our distinguished panel for today. Let's welcome on stage Mr. Sireen Kumar. He serves as Deputy General Manager at the Fintech Department, Reserve Bank of India, overseeing central bank digital currencies and fintech regulation. He has completed his master's degree in management studies in systematic risk from Yale University. He also holds an FRM from GARP, an ACI diploma from Financial Markets Association Paris, CAIIB from Indian Institute of Banking and Finance. With over 18 years of work experience at RBI, prior work at the State Bank of India, he brings valuable insights from banking and finance. He has also been involved in teaching and curriculum development at Reserve Bank Staff College. Join me in welcoming our next panelist for today, Mr. Parthasarathi Patnaik. He is an experienced banker with nearly 30 years of experience at RBS, ABN, Amro Bank, CRISIL, and Tata Steel. He began in risk management and later has led teams in corporate and investment banking. He has an engineering degree from IIT Varanasi an MBA from Jamnalal Bajaj Institute of Management Studies, and is an alumnus of Wharton Business School. He's currently the Chief Credit and Risk Officer at Vayana, where he is establishing a data-driven credit underwriting business. Let me introduce you all to our next panelist for today, Mr. Manish Daswani. He is a B2B payment expert with over 20 years of experience in cash management and commercial cards. Currently, he serves as the Chief Business Officer at Converge, an embedded finance platform focused on B2B payments and supply chain finance. Previously, he has led Visa's commercial and money movement business for India and South Asia. His career includes roles at Bank of America, HSBC, and Citi. He holds an MBA from Sydenham Institute of Management. Let me call up on stage our next panelist for today, Mr. Satish Kashyap. He is the CEO and co-founder of DronaPay. After completing his graduation from University of Mumbai, he completed his business in finance and strategy from the Indian School of Business and has over 20 years of work experience in the field of finance. He loves building and scaling products. He has built products across trading, analytics, risk management, and surveillance. In his last role, he was COO of NSE's technology business. Prior to that, he has also been fund manager at Saffron Advisors, a private equity fund, and was director at SunGard. Let us now welcome the moderator for our panel discussion, Mr. Vikrant Potnis. Vikrant is the founder of Fund Enable, an award-winning platform aiding startup founders in raising capital. Fund Enable has secured over 200 crore in funding for tech ventures, and Vikrant serves on seed funding committees for various incubators. With a background in investment banking and venture capital at JP Morgan and Springboard Ventures, he has worked across sectors like consumer, healthcare, and technology. Vikrant also teaches venture capital and entrepreneurship at esteemed business schools and is a CNBC Startup Nation speaker. Currently pursuing a PhD in venture capital, he has completed his BTech from Sardar Patel Institute of Technology and is a part of Cornell Maha 60, an entrepreneurship program. Now I request Vikrant to kindly lead the panel discussion.
Thank you so much. Thanks a lot. So good afternoon, everyone. It's an absolute honor to moderate today's panel discussion. What we are going to do is, in the next 1 hour, with the help of industry stalwarts, experts, we are going to delve deep in this dynamic realm of fintech. And we are going to try and understand, what opportunities are actually evolving in this fintech sector per se. So what we are going to do is right from payments to credit, from maybe we will delve deep into digital currency to the role of AI, generative AI in fintech. We are going to double click on all these themes and try and understand what experts think and feel about the evolving trends in fintech. So let's deep dive and start our discussion. So I'm going to start with Satish. So Satish, when we hear fintech, the first thing that comes to our mind is obviously payments. And if you see the way India has grown over the past few years, there has been exponential growth when it comes to payments, right? Digital payments. In FY23, 114 billion digital transactions were recorded in the country. And a bulk of it actually came from individuals, right? So this growth, like he was mentioning, is largely attributed to open public infra like UPI. And there are a lot of these newer stacks that are coming up. What do you think about these newer stacks which are going to be shaping the future of fintech from a payment standpoint?
Super. That's a large question. So let me try and first talk about open public infra and why it's structurally a game changer. Okay, so in many ways, this is an example of where India is leading a revolution. So there isn't a playbook that you can copy paste from elsewhere. So to start off, when you're in front of students, I'd say uh, there is one book and some statements from that book that I'd like to begin. I don't read much, so I'm usually that back of the hardbound cover wala reader. I'm that variety. But Peter Thiel's 0 to 1 is one book whose podcast is on Google Podcast, and therefore 4 hours of it, I've heard it twice. So I recommend it. So he says, uh, if you're a monopoly, you take great efforts to say you're a small player in a big ocean. Okay? And if you're not a monopoly business, you take great efforts to tell your investors, I have a huge moat, I have pricing power. This is such a funny thing that he said. So I used to think about it. And he used to say, just look at Microsoft or just look at the Apple Play Store. And he said they'll take great efforts to tell you that, out of such a huge ocean. Now, let's take one of these examples, even for that matter, we'll pick on Visa, as I mentioned earlier. So Visa or MasterCard will tell you, of all of the payment volume, there's such a small section, so they cannot be in any way called a monopoly or in any way, of that nature. And therefore, they have no pricing power. Okay? So if you open up their P&L statement, you will see one of the most EBITDA rich entities that you can find. That is a highly profitable money spinner. So this is an example of what Peter Thiel would have said as, the original God models of business. You have network-based models, you have these platform-based models, so that once customers are tied up on both sides, you're highly profitable. So these kind of plays, I'm just going to say these kind of plays and talk about Airbnb or Uber, assuming they reach a stage of significant activity and control on a market, reach that kind of pricing power. And then the entire system becomes dependent on them. So just 2 days ago or 3 days ago, there was an article saying Visa and MasterCard have increased their interchange fee. Just relate that to a statement I made a few minutes ago. Extremely profitable, high EBITDA. And they've said, we have to set up massive infrastructure to scale and all of that. So what does that have to do with his question? Okay, I'll try and now connect some of the dots. Whenever an element of this nature gives you such high pricing power, we are likely to get squeezed. The Indian model for the same equivalent structure is something that we should now unravel and see. In the early 2008, 2010 timeframes, Paytm was running a model which was similar, which said, I want the merchant to have Paytm, I want Satish to have a Paytm wallet, and I want you all to transfer through this. If you go outside of this closed loop, I will charge you. But in came UPI. And what did UPI say? UPI said, we're giving you a public infrastructure to all. Yeah, we'll use public infrastructure and say that any bank, any payment operator can now interconnect without having to pay an interchange fee. That, okay, in one way, we kind of prevented a PayPal, Venmo, MasterCard, Visa kind of situation in this kind of a payment play by throwing open a digital public infrastructure and saying, you can innovate on top of this stack. The basic stack of interconnect, the basic rules in which a message will go between banks has become standardized, low cost. It has created a whole set of what I call innovation one layer above. Our definition of the word infrastructure, for those of you who think of roads and buildings, keeps on evolving. Okay, so when you go to an IT person, there's a layer of infrastructure that is server, then it'll go API, application. So here what we're saying is that India is looking at building multiple such digital public infrastructure plays. So you look at ONDC, you look at OCEN or the account aggregator model. What we are saying is basically that data or that kind of information which elsewhere in the world required you to go through multiple or go through single, strong network-based players, we're making it publicly available. So let's peel out ONDC and see how that plays into. So today, what is Amazon or what is Flipkart? We have buyers, and you have Satish here wanting to buy a suitcase. So he goes online and says, I want suitcase this size. There is a catalog at the other side from which he sees suitcases, and he kind of filters some dimension. ONDC says the buyer and the seller, this catalog and service is a generic capability that we can provide as an infrastructure layer. Whether it is cabs on one side as suppliers of the service, and whether it's Satish using Uber or Namayatri or another app, it's just an aggregation path to getting to know what is available. So we're creating an infrastructure layer on which we are roughly going to say we are preventing a large centralized network player like Amazon, Flipkart from defining or controlling the ecosystem in many ways. So everyone comes back and says, so where is the business opportunity? And they say, that's what we're looking for young minds like you to look at. Because there are so many ideas that can come, and many of them you may claim are my harebrained ideas, which I got because I was, trying to figure out an example. But just look at it. Today on Make My Trip, you decide to book a vacation. As you book that vacation, they can tell you clearly that you're going to Jammu in January. You need really good warm clothes. I can aggregate that and give it to you in such a way that you can just select. Why? Because they have ONDC APIs through which they know the catalog of things that you're likely to need at minus 10 degrees. And they can throw it to you, and you can then do that transaction a bit faster maybe. Now, is that the innovation? I'm not so sure, but I'm just giving you ideas and saying the moment these public infrastructure layers come in, on top of that is innovation of a different nature. Different nature because there isn't a playbook that I can tell you, dude, look at the US playbook and copy it. No, the world is waiting for the India playbook to be copied elsewhere. UPI is going global. For all you know, account aggregator and the system through which today GST data of my company can be used directly in a loan application rather than them coming over, taking a paper from me, then validating that I have not lied on that paper, taking my bank statement. All of that is going away because of this secure way by which the data is being given. So what I'm saying is, like UPI, there is an opportunity out there through ONDC, through account aggregator, on top of which 1 million startups will come. And I'm therefore of the view that look at them, they're going to throw open many doors.
Absolutely. So before building something, have a look at these open infrastructure things which are available and utilize those to kind of add a layer, and that is your business opportunity.
I actually want to say that you have to innovate on top of a new layer. So you have to think differently because there aren't too many playbooks. So this new layer is going to actually test your creativity.
Absolutely. Great. So, Manish, payments is not only about consumers, right? It also gets into the B2B space, right? And if you see a couple of years, B2B payments, there has been a significant growth in that segment as well, right? So what is your view and your experience in this B2B payment space? How do you see it shaping in the next few years?
Yeah, thanks, Vikrant. And firstly, thank you for having us on the panel, and thank you everyone at SPGen for turning up. It's been fantastic. I've fortunate enough to be here the second year in a row, so it's been fantastic to come back. Yeah, so B2B payments, as much as it is payments, is a very different world compared to what Satish just said. Satish gave fantastic examples of innovation that has happened in the consumer payment space. UPI has pretty much been the cornerstone of that innovation, and you'll probably hear UPI, a few hundred times before this panel discussion is over, because it really is that impactful, right? The rails that have been laid and the kind of applications that have been built on top have been fantastic, right? All of the innovation really has been largely speaking in the consumer space, as you said, right? And for good reason. I mean, it's what all of us can relate to. It solves a real problem for us to make payments on a day-to-day basis. The way we make payments in the consumer space has completely changed, right? So 20 years ago, where most of you were just about born maybe, we were writing cash, we were writing checks and paying by cash for a lunch bill that we had to split between friends, right? That was just the way to do it. Now it's all Google Pay. All of you, or Paytm, or Phone Pay, etc. All of you will whisk out your phones and split the lunch bill in a matter of seconds. The person who you have to pay also has the money in a matter of seconds, and you're done. Now, that experience does not yet exist in the B2B payment space. So let me take a step back, and just for the benefit of everyone here, let me maybe just take a few minutes to explain what B2B payments really are. Not all of you may be aware of what B2B payments really mean. So let me give you a quick background. As the name suggests, B2B payments are payments which are made by businesses to other businesses, right? Very simply, as opposed to the examples that Satish used, where Satish was making a payment to somebody, to a merchant, or to another person. A B2B transaction is where a company is making payments to another company. So think Apollo Tires making a payment to United Phosphorus for chemicals that they buy to make tires, right? So that's the kind of payments that we are talking about. Now, just to put it in perspective, and maybe just a couple of numbers to back this up first. This month, not this month, August, UPI did, if I'm not wrong, for the first time, 10 billion transactions in the month. 10 billion, and which is unthinkable from the world that we grew up in, right? 10 billion digital transactions a month is ridiculous. Compared to that, B2B payments. So B2B payments has largely been getting affected by other systems called NEFT and RTGS, which have been in existence for the longest time, by the way. Why UPI has been like obviously the cool cousin who's come in and made all the noise, but NEFT RTGS has been around for years. In fact, NEFT RTGS has been 24/7 now for the last 4 or 5 years. But because it is not you and me using it, nobody really talks about it as much. But just to give you some statistics, as compared to the 10 billion monthly transactions that UPI does, NEFT RTGS, last I checked, is only doing 500 million, right? So nowhere close. UPI is 20x in terms of the number of transactions compared to B2B payments. Now, if I flip the coin and now talk about the value of transactions that is getting processed through UPI versus NEFT RTGS, UPI, last I checked, if you annualize the number that is getting processed through UPI, that's roughly a $2 trillion annual value of transactions that are going through UPI. Now compare that to NEFT RTGS. That number in NEFT RTGS is 20 trillion. So 10x the kind of value. So that gives you a sense of how these two worlds are different. These are large value transactions that we are talking about, lower in the number of transactions, but huge value. Now coming to your point, on digitization, we've not seen anywhere close to the kind of digitization that we've seen on consumer payments on B2B payments. Why is that? Why should it be any different? I said NEFT RTGS has been around for a while. Why should things not have moved as quickly as they have on consumer? The reason is quite simple. As opposed to a consumer payment where you are, like I said, pulling out your phone and making a payment in a matter of seconds, B2B payments is a lot more complex. What do I mean by that? Let me take an example again of Apollo Tires making a payment to United Phosphorus. Can you imagine, like $1 million transaction that Apollo Tires has to make to United Phosphorus being done on a phone that the CFO or the treasurer at Apollo Tires holds? No, right? So there is a whole bunch of processes that happens before the actual payment can be made, both at the paying entity, which is in my example Apollo Tires, as well as at the receiving entity, which in my example is United Phosphorus, right? That is where, and coming really now to the theme of the conversation today, that is where, to my mind, is the real opportunity for fintechs to play a role. The actual payment transaction, which like UPI is fully automated, fully digital, has been digital for a while now for B2B payments as well. But everything that happens before and after the transaction is hugely manual. It's hugely paper-based, right? And that is where really the opportunity lies in B2B payments for fintechs to leverage, and fintechs are leveraging to partner with traditional financial institutions and sort of bring in the next wave of digitization. It's been the previous wave has completely belonged to consumer. I personally believe B2B payments is where the next sort of large digitization opportunity comes about. For lack of time, we're not covering specific areas within B2B payments, but just at a 30,000 feet level, there are opportunities within B2B payments, like I said, to be automating things on the paying side. So, what are the processes that happen before Apollo Tires can make that payment? So, digitization opportunities there. What are the things that a fintech can help United Phosphorus with to reconcile incoming payments? Is a huge space by itself, and then and the equally large sort of opportunity by itself is cross-border B2B payments, completely untapped. Um, Cross-border B2B payments has largely been the same for the last 35, 40 years, right? So again, all that means is a tremendous opportunity for fintechs to grab that space and sort of bring in digitization there. So I think maybe that gives you a perspective of digitization that's happened and that is happening in the B2B space. But like I started and I'll finish with that is the opportunity is 10x in terms of the value of transactions. So that gives you a sense of what may come in the B2B space.
Interesting, really interesting. So we are always exposed to the consumer side, but thank you for double clicking on the B2B payment side. So we discussed about open public infra, we discussed about consumer payments, we discussed about B2B payments. I'm going to stay with the B2B theme, but move from payments to credit. And Parthasarthi, so one of the major pain points of SMEs, MSMEs in India is timely and affordable credit. And if you see past couple of years, there has been a significant innovation when it comes to both platforms as well as products to cater to this pain point, right? So a lot of platforms have come up. Products such as revenue-based financing have become very famous, right? So what is your perspective on the credit side of fintech and especially the SME, MSME, the credit needs, addressing it through fintech? What's your view on that?
Right. Yeah, first of all, thank you, Vikrant, and thanks everybody for having us on this panel today. I just thought at the introduction just now, and when I heard about Samavesh and the meaning of Samavesh, which is inclusion, in many ways, fintech is playing a role of financial inclusion. Really, that's what fintech is actually driving when you actually peel through the layers. Because all this, it's not as though, to the point that Vikrant made about credit. Credit has been around, banks have been around giving money to borrowers, small and big, for a very long time. Fintech is only playing that role now in actually making it easier, both from a transactional perspective, all these, on the consumer level, we've seen these apps come through. B2B is where the innovation still is work in progress. But really what fintech is doing is actually trying to get credit down to the smallest borrower, not only the consumer, but even the small vendor or the dealer, using a lot of technology, using a lot of data, etc. And I think there's a bunch of things which have happened, not only in India. India is leading the charge in many ways, but across the world as well. So, just staying on that financial inclusion, topic, if I were to just take the example that we just heard about Apollo Tires and United Phosphorus. Now, both of these entities are very well covered by the banking system. There is no need, or they've been around for forever. They're large companies, banks, throng to them to give them money. But then spare a thought for the vendor of each of these companies or the sub-vendor, or on the other side, a dealer, distributor, and a retailer. Most banks only go out to the larger of these entities. They don't go lower because, on the face of it, there is a credit quality issue. The smaller the entity, the more a bank thinks that there may be a credit issue. That is clearly one part of the story. There is another part, which is that getting to these smaller guys is actually difficult for banks because the cost of actually getting credit to them is very high. So I think fundamentally, when one thinks about financial inclusion, it's about really bringing down the cost of financing. If one can actually bring down the cost of financing, then automatically you are able to go out and push that lower cost into parts of that value chain who don't get formal financing today. So in the absence of financing from the banking system, it's each of these small dealers, vendors for that matter, it's not as though they're starved for credit. They do get money. They get money at onerous rates. They get it from the local money lender. They get it from sources which actually undermine their own businesses. What would it take for a large bank to go out to these small borrowers? And that's where I think a lot of platforms are playing this role in coming and bridging that gap by bringing in technology at one level to, in some sense, a lot of banks have outdated technology. Fintechs are coming in and bringing in layers of technology that can actually make processes much simpler. And these could be at an operating level, this could be at documentation level. There are various parts to it. At quite another level, fintechs are playing a very important role in assessing credit differently. So historically, banks have been, for want of any other mode of lending money, especially to the smaller guys, banks have been seeking collateral as a base for giving money. You give me collateral and I'll give you a value, an equivalent value of money to you. Now, the small guys have only so much collateral. The small dealer vendor or the small borrower is limited by the amount of collateral he has, and therefore he can only provide so much collateral, get that much, that size of a loan, and therefore cannot grow his business beyond the kind of collateral that he already has. If there was a way to actually, evaluate his business basis the kind of the volume of business that he does and not link it to collateral, that would change the paradigm. And that is something that is really taking shape right now, because suddenly what's happened is with the advent of GST, for example, there is a view of every business's actual volume of business month on month. There's also data available right up to the previous month. There's banking, so there's something called the account aggregator framework, which is actually in play right now, and it's going to probably get better going forward. The idea is that in the account aggregator framework, banks will be able to share data about a customer, amongst themselves. So what this really does for the banking system is that they have richer sources of data, be it banking data, be it business data through GST, KYC, and such other things, which actually make it easier for a bank to evaluate these smaller customers and probably, actually cross that bridge and make that loan to them that they didn't in the past. I think these are all of the changes that are coming through, partly driven by the government, because many of these layers are being built by the government. And at another level, the fintechs are stepping in and finding ways to use these infrastructure layers to actually push the idea of financial inclusion. I think that's a big thing. So everyone talks about financial inclusion, about getting money to the smallest borrower. Actually, it goes one step beyond that. It's about getting money to the small borrower at an affordable cost. I think if one can actually solve for these two, we've actually fixed the problem.
Absolutely. Interesting. Coming to Serene sir, fintech is a very broad term, right from payments, credit, insurtech, regtech. I was reading and I was counting, and at 20 I kind of stopped. There are so many subsectors. What we want to understand is, from a 30,000 feet view, how is RBI looking at regulating this entire fintech ecosystem?
So, first of all, thank you very much to you, to the Samavesh team, to all everyone in SPJN to invite me, and to the panelists, my co-panelists. Okay, now coming to the question. So as you are aware, financial technology means finance and technology, and this application of technology to finance for improving services for consumers is not new. So banks were doing earlier manual, they had manual ledgers and everything. Subsequently, it was computerized, and core banking system came into the picture. So this is a continuous evolution is happening. Why are we now talking about fintech companies? Why specifically fintech? Because application of technology is happening continuously in finance. Also, in terms of institutions, also see traditionally we had banks, commercial banks who used to do borrowing, who they're basically accepting deposits and giving advances, loans, and then of course the remittances are of course there. Then new entities, NBFCs, non-banking financial companies came to the picture. And over a period of time, they were earlier a very small part of the financial system. Over a period of time, non-banking financial companies grew in size. So as a regulator, when we see that this evolution is happening in terms of new entities coming into the picture, in terms of technology getting adopted, why are we concerned? That's the first question. So we are concerned because we need to be sure about the customer service, that the entity, the individuals, the businesses, they are not cheated. There are ethical business practices there at the micro level. At the higher level, the financial stability is maintained in the financial system, so that these systems, these entities do not pose such a risk to the financial system that the real economy gets impacted, that the jobs of the people get impacted, that the GDP gets impacted. So that's how the regulator comes into the picture. So RBI has its own mandate, which gets derived from the RBI Act, the Banking Regulation Act. There are other statutes. There are other regulators also in the financial system. We have IRDA, we have SEBI, we have PFRDA and all. So this application of technology to finance, it's not just about the entities which are regulated by RBI or it comes in the domain of RBI. It's like all. There can be InsurTech, which is comes in application of technology to insurance. That's also a fintech. And then the technology can be applied for improving our practices, supervisory practices. So that is called SupTech. So if you can make use of this technology and make sure there is some automated way of getting the required information and analyzing them and understanding whether this entity is at a risk of failure, a risk of some kind of liquid failure basically, and whether proactive measures can be taken to ensure that the end customers, if they're depositors, they do not lose money. If there are businesses, it's like known and proactive action is taken. So that's how RBI is concerned about. As a regulator, we need to be sure about this thing. We need to apply in a SupTech context. Then there's a RegTech, application of technology for regulations. Whatever regulations are prescribed, let us say banks have to maintain a capital adequacy ratio of certain percentage. Within that, there are different kinds of risks. There are various compliance, and people who are in the banks, they will vouch the kind of compliance burden they have to go through in doing this. So can all these things be automated in some way? Such that the system takes care of that and only minor changes are required. So all these things encompasses fintech. We can't just say only a payment company or a credit company is a fintech. So now having said that, RBI being the prime regulator in the country, we need to be aware about what is happening in this space and why there is a sudden increase in fintechs. One thing I was surprised to hear, Mr. Manish, was that he's saying the last 30 to 35 years, there has been no change in the P2P remittance. In fact, if you see the last 10 years have been that, particularly in the private digital currency space, which is happening, which has in fact spurred the private businesses and the regulators and everyone to think about ways of coming with their own maybe CBDC digital currencies or things like that, or maybe improve our ecosystem, allow finance innovation in finance in a safe method, so that innovation happens. Innovation is required, and why it is required is because the end users should be able to get the basic financial services, financial inclusion, as Mr. Parthasarthi has rightly said. So they must get in a cheaper way, in a friendlier way. New users like you should be able to use your mobile and use your own other gadgets and able to do transactions without visiting the bank branches and all. Fine. So now coming back to the question after moving around, is that this is the need for financial technology is there. The ecosystem is huge, and what we are doing is that we are trying to understand how to define the fintech companies, and also trying to understand, is there a need for regulating them? Is there a need for regulating them in a similar way as we regulate banks and non-banking financial companies? All of you will agree that it is not desirable, right? Because innovation requires some amount of flexibility, less onerous regulations, less compliance burden, so that innovation can take place. And RBI has always encouraged that. So, but in a safe manner. So there are two categories of entities which are fintech companies which come under the RBI's regulation, and they are called peer-to-peer lending companies and also account aggregators. So these two are categories of NBFCs which are fintech companies, and they come under regulation. So RBI has gone ahead and prescribed regulations for these companies. And there are various kinds of NBFCs who various kinds of fintech companies who collaborate with banks, NBFCs, so-called regulated entities, and they provide a front end to the end users. So they provide the front end to the end users. RBI has come out with the guidelines related to outsourcing of the services for that. So now RBI is looking at defining this fintech space, what kind of regulations can be brought in for different segments. Already NBFCs are categorized into 12 or 13 categories. So can we categorize them into some more categories of NBFCs, or there is a need for a different setup altogether? Or there is a need for self-regulation rather for smaller companies, so that to promote innovation. So all these things are there. I will end by saying that we are aware of the growth of fintech companies. Worldwide, in terms of revenue, as per some report, the fintech companies, they generate around 2% of the total revenue generated by financial companies. But the estimate going forward, let us say by 2030 or something, is a very high estimate, and exponential growth is expected. So we need to be aware. And India particularly is having a huge pie of that growth as per the estimates and projections. So we need to be aware, cognizant of the new entities with new business models who are coming into the space to ensure safety of end users, end customers. And that's why we are trying to categorize different fintech companies. And over a period of time, probably there will be some kind of regulations which will provide the required flexibility
Absolutely.
to the industry.
What the industry would ultimately look for. And I learned a new subsector today, SupTech. I was aware of RegTech, but SupTech is something new which I heard today. Great. Sir mentioned about the interest of the consumer, protecting that. And what we've seen is as the number of digital transactions are significantly increasing, so have the cases of frauds, money laundering, all of that has increased. So if you consider last year and only the banking frauds, 50% were attributed to the digital category. And what is expected is essentially the volumes are going to grow and the percentage share is also going to grow, right? And some of us at an individual level also have been, kind of cheated at a point in time, right? So this problem, which is going to be really, really big in the coming years, how do we address this? And I'm asking this question specifically to you, given your company is actually providing solutions to address this problem.
Okay, thanks a lot, Vikrant. Actually, in the round one, I committed a significant faux pas. I didn't thank all of you all for giving me this opportunity, but Vikrant has made it even more easier. He's like given me an opportunity to do a sales pitch. So I now realize that was like significantly flawed. So yeah, what you are saying is true. It is the thesis on which I'm part of a startup that is running in the area of risk scoring and real time. So clearly, you can view it at two levels, okay? Level one, rising tide lifts all boats. So digital transactions are going up, and therefore automatically whatever was fraudulent, whatever was money laundering elsewhere, automatically has to shift and learn. The other part about it is the fraudsters are extremely brilliant folks. So the latest one, I'll give you the latest one, okay? It's called the CEO scam. On WhatsApp, they call you and or message you with a what do you call that? DP indicating that it's the CEO. So Harshal Mathur messaging his finance guy saying, "Can you please release 50,000 rupees to this vendor?" And you have not. And I've sent that email yesterday, and that fellow has fallen for it. Okay, so he's really thought his boss wanted the money to be transferred. Now, this is just one level. So how many of you have received an SMS saying, you know, your electricity connection is going to be disconnected, click on this link to pay a bill? Come on, just to wake up the backbenchers. Super. So as you can see, them fraudsters are doing a great job. They're running a extremely efficient marketing campaign to catch people. They've even tried to send messages to my mother to get her Aadhaar data. And she's called me saying, they've said I can't operate my SBI account from tomorrow. So I'm like, man, this has reached alag level. So automatically there has to be, I mean, defense against the dark arts or the equivalent, and therefore thus arose Drona Pay. Okay. So what do we do? So what we see is that on multiple levels, we are seeing problems associated with frauds, scams, money laundering playing out at a retail level. We don't operate extensively on the B2B level because there, as you may have read, the frauds are in tens of thousands of crores and beyond my reach to measure those numbers. So the range that we work is 5 lakh, 10 lakh variety, that kind of number. So we see a whole array, as I told you, of activities here. So let's just take fraud and try and peel that a little. You have the old world credit card fraud. You are sitting here and a transaction SMS comes to you saying you're in Disneyland, Dubai. Okay, Disneyland's not there in Dubai, but anyway. And then you realize, oops, and then you realize someone has your card details. That so-called CVV has been compromised, which is also there on the card. Significant changes happened over there because in India, PIN OTP has been introduced as a factor of authentication. This is not the case in many other countries.
Even in the US, I mean, OTP is not there.
Yeah, and I can tell you who are these wonderful agencies who said that it's going to add significant friction to the transaction if you add PIN and OTP, and therefore it will stop transactions itself. They've convinced the US regulator. I shall not name those 2-3 entities as I've named them many times before. And therefore they sell solutions over there saying, we are ensuring the network is risk-free by doing other things. So please understand. So it could be a problem of the era in which they started and therefore a disadvantage versus us. We are in an era where we've been able to force ourselves into PIN OTP. Sometimes it's an overkill. And I think there are some steps being taken over there also to say that if you have transacted on Zomato and have registered with that payment processor, up to a certain limit can happen. So we are also taking technological steps to say that because I have a biometric or a device biometric and I have a binding done, and I know Satish transacts with Zomato frequently, if he transacts less than 1,000, just an approach to simplifying the security process in order to see, we got to provide a balance between the two, preventing fraud and the friction in the transaction. So that balance is eternally sought such that you're able to let through as many transactions as possible without stopping them. So that's one step of one kind of problem statements where in UPI today, we've gone one stage further in order to do that ease. We've introduced device binding. So the moment you change your device, we've introduced it. So what has the fraudster done there? He sends these wonderful SMSs with saying, tomorrow is your due date for income tax. You have not paid 43,442. Click on this link now to pay. And there are people who've fallen for that. So there's a significant bunch of communication happening that, don't fall for this. But there's also significant intelligence being built into bank networks, seeing, is this a new VPA handle? Is the handle named Army Welfare Association when it's a retail bank account, not even a registered NGO, not a merchant category like that? So we are taking steps. The regulators push these steps. So these phishing scams are a key area where machine learning models are coming into play. We're trying to identify, you have not paid to this account before. As HDFC Bank, no one has paid to this account before. The account has Army Welfare India created. It is getting money from multiple people. All of a sudden, it is likely to require certain amount of validation. So create an alert. So that kind of a leveraging of ML to bring in, this problem, reduce this problem is there. We've had SIM swap, where we've had NFC card related issues. So, many of these cards have now been enabled for near field. So tap and you can release payment. And then everyone's now suddenly worried. I know people who carry an aluminum foil, not for their idlis, dosas or something, but to wrap their card and keep, because they're in worry that, someone's going to tap them somewhere and take away money.
Wow, I didn't know of that solution. So wrapping a card in aluminum foil.
See,
all my
we didn't
cards are in my
communicate
wallet.
this one to you. No, so it's not needed. It's not needed though. Okay, I'll correct myself. But so there's significant amount of rules and ML models coming into play to put in limits related to NFC. That is, even for a particular Starbucks, if they do 50 NFC transactions within an hour, we know it is suspicious. Even if you see NFC transactions with 7,000 rupees at Starbucks, you know it is suspicious. I mean, I know you love coffee. I know you want to gift the whole planet that coffee, but 7,000 at Starbucks is a little overboard. So what I'm trying to say is there is a way for a system, a rule, an approach to tackling these problems.
Understood.
The problems are larger. The problems are growing thanks to the 10 billion transactions that are going through the system. And so we're building software systems to prevent that. And it's an ongoing race. So coming back to Peter Thiel, who I started with earlier, he said, it's a moat if there is a constant problem which keeps on evolving and you have to solve. It's like the doctor.
So you want these guys to actually, there has to be a parallel panel discussion happening somewhere underground talking about how do we increase the share of, so that companies like you can actually, great. I can almost like,
Mind said all of it.
No, just a disclaimer, it's too late for a disclaimer, but all the views expressed here are personal views, nowhere related to the organizations that each one is representing. I am going to actually, go to Partha first. And Partha Sarthi, one question that I have is, while we are all gung-ho about fintech in the room right now and we are talking about the growth, the venture capital, investments in the space is actually not looking that great when it comes to fintech right now. Okay, so if we look at the first half of 2023 versus the first half of 2022, there has been a 67% drop in fintech investment. So obviously we know that India is going through a funding winter and so on and so forth, but fintech has been significantly impacted, right? So my question is that what is it, and again, a bulk of that, bulk of first half of 2023 saw a large transaction in PhonePe. So if we actually remove that, the drop would be significant, right? So I want to ask you, what are investors looking at while investing in fintech? And I'm seeing some eyes from that side in terms of time. So what do you think in terms of investors looking at the fintech space per se?
Yeah, so maybe I can put this in perspective by giving some numbers, since you mentioned that. I was just seeing some data recently. So this is not about India only. So globally, I think in 2021, the total investments in fintech were $100 billion. 22, $63 billion. This year, $20 billion. That's how steeply it's fallen. So clearly something is wrong. But actually, when you think of it from an investor standpoint, what does an investor do when the environment is a little vitiated? What do you do when there are geopolitical risks? I mean, remember, all of this money is not India domiciled money. This is money across the world. VC money is largely flowing in from global centers. That money is being held back for some reason, and that is because there's a very enhanced risk perception across the world right now. There is the disturbance that we are seeing in Ukraine. There are economic headwinds. You've got the inflation risks in the US and so on and so forth. That's the larger macro picture, which is generally affecting VC investments at large. The other bit is around fintech. So what's really happening in fintech? Just coming down to fintech. So it is a fact that there was euphoria 2 years back. I mean, fintech is the poster child of any investor, right? Or was the poster child. And whenever there's euphoria, what really happens is, and this happens to all of us as well, in a bull market, we don't diligence our investments as much as we would in a bear market. And I think that's clearly what happened 2 years back. There was a case of FOMO at one level. Investors were jumping over each other to put money into companies because there was this thought that they might miss out on an opportunity. That led to soaring valuations. That led to, of course, extra investments that were made then on promises made by companies which haven't been kept. Now, that's the other part of it. So, for most part, VCs invest on basis growth. I think growth is clearly the mantra that VCs look for. But there is another critical factor that also needs to be taken care of, which is profitability. You just don't grow by burning money. I mean, that's never going to get you anywhere. I don't know if any of you watched some of these serials on WeWork or on Uber. If you haven't, I think they're on OTT channels. I don't remember which one. But do watch them because it gives you a perspective of how startups operate and how VCs think. And in many ways, I think that's what's happened in the fintech world. I think there were a lot of promises made. A lot of money got burnt. Profitability or growth that was expected did not happen. And which is why, and coupled with these global factors that I talked about, has led to VCs actually thinking hard about the next level of investment and tightening their purse strings. VCs are now actually calling out fintechs and frankly every other startup to tighten their belts. VCs are actually calling out companies because the profitability metric isn't being met or hasn't been met. So suddenly from the focus on growth at all costs, it's moved to growth plus profitability. And soon it will be only profitability if things continue the way it is today. Sure. But and I think that's a good thing. It also gives a time for startups to actually sit back, evaluate what they are doing. Yes, everybody is on a very fast-paced environment, very different from the banking world. There's enough innovation happening. But just going back to what Mr. Sirin said, as he concluded, the fact of the matter is the opportunity for fintech is still very large. It is, I think this is a blip right now. I think I may have read the same report that you were alluding to. It talked about revenues or the valuation or the value of the business or the financial services business in India being about $400 billion by 2030, of which 70 billion will be the fintech sector. That's about roughly 15%, up from 2% just a couple of years back. Now that's a massive story waiting to play out. So there is still a lot to be done. I think it's still a very, very exciting sector. The investors may have pulled back a bit, but I think it's a blip. They'll come back again.
Yeah. So for all those who are actually looking at starting something in the fintech space or working with possibly fintech startups, what I gather is basically, fundamentally things are going to grow. Because of the macro situation, the funding has reduced. But what has changed is the business model, which is what VCs are looking for: growth at any cost to profitability on day one, or at least path to profitability, right? So I'm going to take final two questions. We have 5 minutes to take final two questions. Because without this question, in a very crude way, panel discussion का पैसा वसूल नहीं होगा. And the question is, to you is generative AI, right? And we want to really know the role that generative AI is going to play in fintech in the next few years, and most importantly, as students, as professionals who are going to enter in this domain, what kind of now skill sets I need to kind of have to adjust to this new model where generative AI is going to integrate into businesses and fintech specifically. And please feel free to kind of chip in wherever you can.
Yeah, thanks, Vikrant, and I'll keep this as brief as I can. And when we met yesterday, to have a conversation about the panel discussion, we were joking about how. So I was here last year, like I said, and what generative AI is to today, BNPL was last year. So exactly the same conversation last year. We said we have to talk about BNPL no matter what. This year we said we have to talk about generative AI no matter what, right? So force fit it if we have to. No, I'm joking, but on a serious note. I think it is obviously something that is very, very relevant, right? And hopefully all of us know what generative AI is as opposed to things like predictive AI. And two examples I'll quickly give of, generative AI versus predictive AI in action, and then, love to hear everyone else's views as well. In the space that I come from, which is B2B payments, right? And actually this is probably more consumer and B2B together. So think of it as, I've worked previously in a payment network. What we had lots of was data, right? It like literally terabytes and after terabytes of data, and that had been getting stored for decades. What things like predictive AI and generative AI have allowed payment networks as an example to do is to come up with value-added services on top of that data and offer that externally to banks, to sort of tourism companies as well. And I'll give you one example. One of the products that I've dealt with in the past was called Travel Predict, right? Based on data that payment networks store, they could actually effectively predict, and this is now predictive AI, where Satish or Partha or Serene are going to travel next, as long as they are card users, right? And as you can imagine, that is a very, very powerful sort of data set that anybody can really use in order to intercept and sort of make sure that these gentlemen traveling to a place where me as potentially a card issuer or a marketing company, for example, if I know that they're going to be at a place at a certain time, purely based on their historical data, then that is a significant, piece of data for me to get. So that's an example of predictive AI, because I'm predicting, where the next kind of travel is going to come from. Now, if I use that to, to take it a step further and think generative AI, can I then use that same kind of information to potentially generate offers that I can present to these gentlemen here when they are traveling, when they are on a flight, ready to take, that flight with their families, and say, hey, by the way, at the place that you're landing, here is a 20% discount at the airport when you land at Starbucks, right? That is super powerful, right? And that, if that message that I can generate can be auto-generated using the data which I already have at the back, that is an example of generative AI, right? So, and there are many, many such examples that we can come up with. But the reality is that that has a direct, real application in the space that we are all operating in. And there can be endless such examples where there can be serious value that generative AI can add.
Absolutely.
Just to quickly answer your question about skill sets, I mean, very sort of broadly, the way I think about this is, you obviously necessarily have to understand what generative AI is, what it does, etc. But I think the key is, can you get to a point where you can apply that to business scenarios? Can you think of ways or skills in which you can make generative AI, real? Can you make that come to life by applying that to real life business cases, real life business scenarios, an example which I just mentioned? I think that will be the key for all of us in this room as we progress in our careers. And needless to say, given what everyone else has spoken about, it has to come with safeguards, right? So all of us, while we are super excited about generative AI and its possibilities, it has to necessarily come with controls, with safeguards. It probably feeds into more fraud scenarios for all you know, and therefore the importance of learning safeguards and controls probably becomes even more important. So well, yeah, I'll probably
Absolutely.
stop there.
And I'm expecting a lot of questions on this topic when we open the floor for questions. Before that, one last question to you, sir, is RBI has been taking a lot of steps to foster innovation in fintech by opening sandboxes, conducting hackathons, giving out problem statements. From a student standpoint, what I want to, and entrepreneurs and student standpoint, what I want to ask you is, can you give us an overview of maybe a few things that we should look for, watch out, if we are, wanting to kind of roll up our sleeves and create products that address certain, pain points that you are seeing in the market? How do we actually get access to that?
Before I respond to your question, I just wanted to respond to Mr. Manish
Sure.
this discussion. One thing, he gave the example of using data for giving advertisement of certain offers and things like that. Now you are aware the data privacy bill is there, and these things are going to be challenged. So if you are going to use the data for creating a picture using generative AI, or using it for creating a music, maybe it is fine. But for this kind of offers, this is putting a regulatory hat. Sorry about that. But these challenges will be there. But anyway, by the lot of potential is there of this particular technology, and I don't discount that. Now coming to the question about RBI's role in encouraging innovators in the financial system. As you are aware that RBI has created a lot of institutions earlier. It created IDRBT, NPCI, now which is spearheading the UPI. It has created RBI Innovation Hub, Rebit, IFTAS, so many companies, and our own fintech department from which I belong. It was created as a department last year. So we at the fintech department, we are responsible for the regulatory sandboxes, which is operated by RBI, in terms of which these are theme-based regulatory sandboxes have come initially for 5 theme-based regulatory sandboxes. Let us say retail payment, offline payment, fraud detection, things like that. And a window is opened in which innovators can come can make their entries for their innovative products. So now the issue here is that who can come in a regulatory sandbox, and why should they come in the regulatory sandbox? They can do their experiments in private, but you need to come in a regulatory sandbox when the regulations do not permit certain kind of products. Then in such cases you need to approach this format and ask for certain regulatory relaxations, so that because your product needs some relaxations.
Got it.
Yeah. So for that purpose, for a specific use case, you get that for a specified time. And then we also understand that what kind of risk it poses to the system. You also understand as a private sector that whether you're thinking about the product, whether it's going in that direction or not. And then at the end of that process, finally, a call is taken by us regarding the regulatory relaxation to continue.
Absolutely.
But one thing is sure, that people who come forward in this format, they get a recognition, because RBI by its press release, it comes forward and says that so-and-so company has completed. So there's a whole lot of review process and all, which I'm not going to discuss here.
Is it open for individuals as well, or you have to be like a private limited company?
So there's a set of criteria,
Okay.
and mostly it is for companies. So that the criteria is fully laid down in a press release,
Perfect.
you can see.
Great.
So apart from this theme-based regulatory sandboxes, this theme-based retail payments, frauds, things like that, at the end of that theme-based regulatory sandbox, what happens? It becomes on tap. So thereafter, innovators can submit anytime applications for that. When it ends, till that time, you can submit in that specific time window which was opened. Then now we are coming, still it has not come, but we'll be coming forward with theme neutral regulatory sandboxes. Anytime you have any ideas, anything, you can come forward. So this is about regulatory sandboxes where you need some kind of relaxations and all. But there is another thing which is hackathon, competitions wherein certain problem statements are given by us, and on the basis of that problem statement, innovators have to come out with a solution. The entries are shortlisted, reviewed, time is given for development, and finally shortlisted for winners. Prizes are given in that. Prizes are given in this Harbinger. So we have done 2 hackathons,
Yeah.
Harbinger one, 2021 and 2022. And then another thing is under the G20 India's presidency, we have done a G20 tech sprint. So again, in which global, normally for our regulatory sandbox, only domestic companies and all are allowed. For Harbinger Global, were allowed. For G20 Tech Sprint, of course, under the G20 umbrella, done by RBI in collaboration with BIS Innovation Hub. So here, global innovators were allowed to participate. And very soon, the results will come announced by the governor on 4th. So you'll hear that. So these are some of the avenues which are available for innovators.
Yeah.
But maybe not at this stage directly coming out of the college.
Yeah.
But few years down the line, they must be aware, because I get surprised to know when I talk to many fintech companies and all, people, they're not aware. Even at that level, they're not aware that these opportunities are there, where they can get their product highlighted.
Absolutely.
And recognition can be there, and which can help them.
Absolutely.
Yeah.
Great. So what we are going to do now is, whatever time we have, you can guide us. We can take up a few questions. Audience, any questions you have for any of the panel members, please go ahead. Yes, we have some microphones at the back. There are a lot of questions. How much time do we have? We have, right? 10, 15 minutes. Great.
Good afternoon, sir. Kashyap sir, I had this question for you. I'm just setting the context. First is UPI clocked 10 billion transactions last month. And then there is on one end, and then the opportunities, that is 60% of the cash of the transactions are still cash transactions. Then third is that banks are bearing the brunt of the UPI cost. So investment in the infrastructure for UPI, banks are bearing the brunt, and for the RuPay debit cards. And finally, there are frauds happening in UPI. Now, after having factored in all this, how do you see the future for UPI payment wallets and the security for the entire ecosystem?
Okay, that's a good set of questions. So what you're saying is basically UPI to a bank is a free service. There is a problem of frauds. There is a cost of UPI service. So this reminds me of a discussion that I had long ago with a gentleman who told me, tell me one public infrastructure service that is free absolutely. Okay, so I was like, my answer was email. So he said, what is this UPI message? If you look at it, it's very much like an email. There is a message, there are certain fields that are being transmitted with certain security protocols. Are you saying that this can be done without technology? No, it needs technology, it needs network connectivity, it needs server capacity. So is the cost structure commensurate such that today for email as a service, we are charged? We're charged by Gmail because if I, as a company, decide to use Google Workspace or I use, but otherwise the core of the email service is free. How is it free? So to a certain extent, one needs to understand what is the cost structure of UPI. There was an era in which an NEFT message had a certain cost structure. You have to now think from that era to now, what is the cost of technology associated with processing a message? Okay. There is almost negligible cost structure for processing a message because email is free. Let me tell you, that's also a message which is being processed across email servers, being sent to infrastructure. There is a DNS server, mapping, doing all of that freely. And that, I'm telling you, is doing more than 10 billion messages because I know so many useless people who mark so many CCs on so many emails and it goes to so many people and irritates the daylight out of them and is running free. So I mean, I'm not trying to say that because it's an email message, it should be free. But look at the concept. There is a float that a bank earns the money on. There is a certain transaction fee that is associated with many services. Today, therefore, if you look at it from a digital public infrastructure standpoint, there is value because finally that money is going into the bank is going to earn some float on it. Is it justified, not justified, is a call. But as a minimal service level today for a message being transferred, I don't see the need for paying any fee. Maybe I'm a socialist because I said it or whatever, but that's my view. I mean, of course.
So it's not that the entire burden is taken by the banks. Government subsidizes that. So there is a MDR, yeah. So there is a subsidy which is available for UPI transactions, and in India, anything unless it is like promoted, it's like they're so conscious about the cost. People are so conscious about the cost. It does not pick up actually unless some kind of incentives and free of cost is there. In US, I'm not 100% sure about which law, which particular section of the law is there, but for public infrastructure, there is a concept that they need to essentially charge money. So, but in India, that kind of law is not there. In a long-term perspective, again, as he has disclaimer, he has already given very nicely that these are all personal views and not the views of the entities we represent. So, on a long-term view, for a sustainability point of view, certainly there is a need to have a cost of these things. Then only the institutions can sustain, the ideas can sustain. Otherwise, it's not going to. Today, the government is subsidizing it for this thing, and even the banks are bearing partially. But going forward, certainly there has to be some kind of cost associated, revenue model associated with it. Yeah. Thank you.
Oh, hello. Oh, yeah, good afternoon. First of all, I'd like to thank the panelists for such a great session. Thank you. So, sorry, I'm here. Yeah. So my question is that recently fintechs have started collaborating a lot with traditional banks, but yeah, the way traditional banks have been working throughout the years is very different from how fintechs work, both on their approaches and functionality. So what kind of problems do fintechs and banks face when they're collaborating with each other?
Sure. So you're spot on. I think if I see what's happened over the last 5 to 10 years is that, a couple of 3 or 4 years ago, actually the conversation was when fintechs started to become very relevant is, will they actually take over from traditional financial institutions? And there was, for some reason, there were talks around, will fintechs take over all of these as businesses and will traditional financial institutions not exist anymore and all of that? I think it is safe to say that none of that has happened. I think the best sort of models that have evolved is where fintechs have partnered most efficiently with underlying traditional financial institutions. And the most successful fintechs, and actually even the most successful banks for that matter, is where these partnerships have worked the best. I think not so much problems, but I think over time what they've had to iron out is what is core to their business and what do I do best. So I'm a bank, let's say. My core job is deposit taking and lending, right? That is my existence. I think what happened over the last 10, 15 years is after that back and forth, what a lot of traditional banks realized is that that's what they're good at, and they began to acknowledge that there are other areas of finance and technology that fintech is better at than them. In the same way, I think fintechs also realize that they can't take over the world, right? And they can't do everything that a bank can do, for instance. And they left the sort of expertise of deposit taking, lending, etc. to the banks and did what they did best. So I think that is probably what has worked the best. So I wouldn't say problems, but I think that bit of back and forth or overlap about that existed, especially in the payment space, between what fintechs can do and what banks can do, has now found a new level where both entities are now a lot more comfortable partnering with each other. Large global organizations like a JP Morgan and the like have gone on record saying they are happy to partner with fintechs to augment what they do as a core business. So I think that's really what has been the sort of partnership spectrum, so to speak. I hope that answers what you had.
I just add one point. So the statement that I heard, which kind of resonates, is: will the fintech grab distribution before the incumbent banks gather or capture innovation? What's happening is the fintech today is trying to say, I will get access to those end customers or bring you those end customers. And the reason they are saying that is because banks are not able to innovate and create those technology elements. So is the fintech that wants to grow, it has to gather that level of distribution might before the bank figures out how to innovate its technology stack to get its offering on par with a fintech. It's like a race between the two of them. In multiple areas, you can see that banks, in the Indian context, if you were to look at it, you had people launching neobanks, which were basically new front ends to internet banking, mobile banking. On the other side, banks internally have launched their own challenger banks within the bank to say, you create a better version of net banking and mobile banking. So what is happening in this mad rush? On the one side, there's a customer who says, I now have a fintech app which is able to tell me better what I spent money on. Because the bank was not doing that to net banking, was making that net banking interface exactly the same from 1998 when I started using their, I don't name the bank, okay? So their interface was exactly the same. Fintech came, took the same data set that was available to the bank and made me realize, oh, I'm spending so much money on movies and I think it's great insight, which I love. The bank is now offering a new front end and saying that I will innovate, and whatever that front end and user interface that this young man, wants, we will give it to you. So the race is on. Will the bank innovate fast enough on tech? Will they distribute fast enough and get access to so many young folks like me that, they're the next bank is playing out, yeah.
If I can add here, now it has become, if you watch, there are some TED Talks which are there, like 7-8 years back, TED Talks and all, which gives a very beautiful, explanation about how fintechs will evolve in future, that banks will become a back end, they will provide the balance sheet, and the fintechs will become the front end, customer facing bodies. And we can see that playing out a lot here. And we can see, and this is now being recognized. RBI has now come out with the FLDG guidelines, and they have come out with the outsourcing guidelines. What kind of protections, what kind of guidelines for customer protection, transparency, informing about the various kinds of rates, doing those transactions in a transparent manner, the credit, the risk sharing which has to be happening between the banks and NBFCs, banks and NBFCs and fintechs. So all these things are now being kind of put in guidelines, so which is kind of helping the ecosystem in that way. Thank you.
So if I can just, I thought that was very important. Actually, what's really happened is that RBI has cleared the air on what a bank can do and what a fintech can do. And a fintech is not a bank. I think that has been very, very clear. That in some sense has led to various different models of collaboration where a fintech is not stepping on the bank's shoes, knowing that if it has to be regulated. And since it's not regulated, it can only be a service provider to the bank. And that has actually cleared the air around this. I think that has been a very major step forward by RBI, which has led to partnerships actually getting stronger.
And even not just banks and non-banks. So fintech peer-to-peer companies are also fintech companies, where not necessarily that banks are the only entities or NBFCs are only entities which can lend. Individuals like you and me can also lend using a peer-to-peer company platform, right? So
there are some questions in the front as well. Okay, sorry, go ahead.
My question is age of advanced fintech, why the payment aggregators still put liability of an international transaction chargeback on the merchant? Why they should take the liability from themselves?
Sorry, you're saying for international card transactions?
For international transaction chargebacks, why the liabilities given on the merchant by the payment aggregators? They should take it on themselves. I mean, in this age of
No, I think that's a problem around the fact that the extent of chargeback, unlike India, where you have OTP PIN based validation, many international networks or international countries don't require that. So therefore, for international transactions, the chargeback rates itself, the chargeback ratio itself is higher. So you get a card from a Romania which does a transaction, you don't have a PIN, you don't know whether it's a stolen card. So many payment aggregators have said, we won't even process international cards. So the ones that have agreed have said, if it's a chargeback finally that comes, you merchant can take a call. So that's the current approach because...
I think not implemented yet. They are still putting it on the merchant only.
No. Even the ones, many of them have said, we won't even accept international cards. Many of the payment aggregators in India, after this problem, don't even accept international cards because we are doing risk scoring for some of them.
Yes.
So they've said, what, international card, we will decline, boss. Why? Because tomorrow if there's a chargeback, I have to go through a large cycle. There is an arbitration fee. There is a process which is defined by the networks. And the reason for that is, it's very easy to do a chargeback in certain jurisdictions because of the way the rules are. In India, you try and do a chargeback. He'll tell you, boss, you entered your PIN number, you had your OTP. So it becomes a much more complex process to prove that it wasn't you. So therefore, the need to take on that international transaction, what they're saying is the call of the merchant. Dear merchant, you want to take the risk of taking an international transaction which has a higher chargeback. Take it knowing fully well that if it becomes a chargeback, it's yours. That's the current approach. And that's roughly the approach that's running in the market, and I can see why. But
Yeah.
Thank you.
A very good afternoon to all the panel members. My question would be, sorry sir, Karanveer this side. My question would be that what are some of the challenges which still persist for fintech organizations in reaching to underserved populations?
Okay, a fintech catering to underserved population is in some way a misnomer, an oxymoron, or any of those words?
It is more related to the acceptability of fintech fintech solutions to the populations which are yet to. So
Okay.
it is more on those lines.
I'll just quickly start off, and then I think others will add to it. There is one set of fintechs which I will call, for simplicity's sake, the cred equivalent set of fintechs. They are talking about targeting the same set of customers who have huge spends. That's not the segment that you're talking about. Then there's the set of customers. I'll start with the other extreme end, the Chinese lending apps which were at the other extreme end. We don't want to know anything. We want to lend and catch you, as in get you trapped at the other end. So if you're talking about financial inclusion and fintech in the same context, please realize there is way too much innovation and risk capital that you're talking about in that same word itself. So you are going to go to a market where you're innovating on a product where you have huge risks with data sets not available, history of performance of that particular section not known. We've had so many years where we've been trying to enhance rural lending, enhance small ticket, microfinance, and all of them. So I think that today it would take quite a daring fintech to get into that space. And I don't know of too many in that space, so most of us are catering to the highly served. So I'll...
See, while the private fintech companies, most of them, I guess, they're not there to do charity, right? So they have to come up with a business model which gets them money, but in the process it creates efficiency in the financial system because using technology they are able to do that, and it provides it's able to service those category of customers who are not already covered. But there are as RBI has created RBI Innovation Hub, the latest monetary policy you would have heard, there's a public tech platform which has been created also. So, which is going to kind of aggregate all data and provide a outlet. I mean, banks or NBFCs, they can tap to that and they can take quick credit decisions. So many of the, you are aware that Kisan Credit Card is there, which is a collateral free loan under the Kisan Credit Card. RBI has done a pilot in terms of which collateral free loans up to 1.6 lakh rupees. I mean, there's a limit. Let me not get into the limit, but up to a limit that loans are processed automatically because data is fetched from certain land records of the state government, proving that they have the land and no collateral is required. So automatically through the state, through processing, the loan is disbursed. Similarly, there's a pilot in which a dairy project is there. The milk generation capacity of individual farmers and all are recorded by Amul federations. Those data is captured, and based on that, loans can be given. Similarly, a lot of data, satellite data is there giving crop patterns. There is a GST data. There is a whole lot of data which is captured by credit information companies and all these things. So all these things put together, now a new announcement has been made about the public tech platform. The idea is that through a straight-through process, with a lower turnaround time, loans can go. So because this ecosystem which has been created by the fintech companies, the continuous development with the help of public sector, private sector, which is happening, and naturally people who are there, they are getting benefited with the combined efforts of the government, RBI, private sector, everyone.
Interesting.
The general feeling is, certain, I mean, industry is more regulated like banking and finance. But if you see others, like, if you talk about technology, competition, monopoly like Google, I mean, it's not regulated as much. So, what is the underlying philosophy of the government? Basically, there's also a clash. Like American companies are more liberal. I mean, they want more individual, whereas some Asian countries are more nationalistic. So, I mean, if you're a product designer, what do you think? I mean, where would the government come in to play, become a regulator and, govern these companies? What is the underlying philosophy? Because certain places you see that, as a consumer, you don't actually require products, but the Googles or, and the tech companies, actually push it. And, and like you said that people are scammed and fraud. I mean, that's also one sort of a scam. I mean, you don't require a particular product and you are being given it and you enter into a transaction and it becomes a legal transaction and you can't, actually dispute it out and it will become too difficult also. So, I mean, do you think Indian governments or, Asian governments step into it and, tell that, okay, this kind of monopoly is not required out here?
I think this question should be directed at Mr. Sirin, but I'll take a stab at it. So I think fundamentally, look, financial markets, unlike Google, etc., necessarily have to be highly regulated because there's money involved and there's people's savings involved, etc. And which is why in India we have 4 regulators: RBI, SEBI, IRD, etc. Anything related to money, financial markets needs to come under one of these regulators. If one has to innovate, it has to be innovate. The innovation has to be within the rules which have been framed by the regulators. I think there have been several cases of people using regulatory arbitrage, which is essentially seeing a gray area and stepping in and trying to do something there. I think to credit to our regulatory framework and our regulators, the regulators have been quick to come in and block that out. And I don't think there is any scope to build a business based on regulatory arbitrage. And I think VCs have also in the past deliberately allowed that to happen, have burnt their fingers because RBI has come down and stamped out a lot of these things. So to your question, I think it is important to understand that financial markets is very different from Google or any other market. There are regulators. Whatever has to be built, product or otherwise, has to be built within this framework which has been set out by the powers that be.
And wherever there are gray areas, there are many gray areas still there. So that continuously gets evaluated based on, let us say, for example, earlier there used to be a lot of collection of deposits by various companies, and at the end of the day, there will be fly-by-night operators, and suddenly one day that company is closed and people lose money. But over a period of time, because of the various efforts taken by the government, by the regulators, those kind of cases have come down, come down a lot. You don't hear too many cases nowadays. So, like that, RBI cautions people about these kind of issues, let us say cryptocurrencies or something, that people should not burn their fingers because right now the regulations are not there. They should not fall prey into those things. Just looking at the valuations, they should be aware about the risks. So the gray areas will remain, but the regulators, the authorities, they watch that gray area. If it is becoming a problem for the consumers, for the economy, steps are taken to ensure that it is plugged and the loopholes are avoided. Thank you.
Sure, go ahead.
Hello all. First of all, thank you to the Samavesh team and the panelists for such an interesting discussion forum. My question to the panelists is on the emerging AI technology in the field of investment management. So we know that there are robo-advisors or digital advisors coming up in this field. So what do you think are the ethical issues that might come up when employing all these robo-advisors?
I'll take a first cut at that. So, I spend time with the National Stock Exchange, so that makes sure that whatever I answer will be wrong, but even otherwise, anyway. Algo trading is not new at all. Okay, so algo trading in the context of writing a program which says it will generate orders and trades has been there for a long time. So whether it is to execute large orders or to take news data sets. For example, we have sentiment analysis bots running on Twitter while placing orders on the other side. And I've seen them in operation for a long time. Now, there are multiple views on this. Should it be allowed? In one way, the market says this is part of the overall liquidity that is there. This ensures that whenever you want, there is maybe a robo, maybe an institutional investor, but he's providing you instant liquidity and depth in the order book. So you walk into whatever Ajanta Pharma, Z Tele, and you want to sell, buy. Maybe it is a robo on the other side, but it's still providing you that price discovery on a continuous basis because of its existence, because of its there. You're taking it one step further and saying, I have a robo investment manager. Even today, there are already preset models for how to go about asset allocation. I won't go into the textbook, but there are textbook approaches to what is risk, what is the efficient frontier, and all of them. So therefore, is it just being automated such that it takes answers from Satish in order to clearly define what should be Satish's portfolio allocation? Well, that's been there for a while. Huh? So knowing my risk profile, making me answer a risk questionnaire in order to gauge how much should be in whatever, FD versus equity versus short term, small cap versus long cap. So this has been part of the investment textbook and execution. We may be automating it. If we are only doing automation, then it's nothing. We've always been doing automation and trying to make it more efficient. And therefore, now what about the robo-advisor becomes a point of contention is therefore the question. So is it, so the same question I'll take back to my experience. What about the algo trading was a point of contention? The key thing was on days when there was extreme risk, the algo behaved like a machine and didn't realize that it should not try and kill the entire market in the process. For it, therefore, there are thresholds placed. So there is, whether you call them low water marks, whether you call them, preventing the ML system from hallucinating, there is a set of frameworks to prevent risk. So you do put up these guardrails. And that, just as much as is needed for a software program, is going to be needed for a robo-based, ML-based approach as well. So what I'm saying is, I don't see this problem as being, it's not like automating, giving a generative ML model the right to perform a surgery. It's a lesser complex problem than a car riding on an automated way. Because we've been doing it in an automated way for a long time. There are rules. We just have to bring in the guardrails.
Great. Thank you so much. Thank you for actually double clicking on each of these topics. And that brings us to the end of this discussion. And I would like to thank all of you for patiently listening to each one of us. Thank you so much for giving us an opportunity to interact with you. Thank you.
Thank you so much to all of you for treating us with such an interactive, relatable, industry-focused and yet entertaining panel discussion. I'm sure every single person in the audience will have an enhanced sense of intrigue about the concepts that we might have felt were very daunting earlier. Vikrant, being an astute moderator, as he is known to be, has ably orchestrated the panel discussion to extract the rich experiential learning that all of the panelists brought to the table. A few takeaways which I would like to mention here would be catching the crux of Samavesh, which is inclusion of finance and technology, becoming the backbone of each and every sector across the business landscape. Advances in Fintech by regulated innovation with perfect amalgamation of rules and technology, and how the Reserve Bank of India has been working extensively on it. Reach and ease of timely and affordable credit, not just in the B2C, but the B2B space as well. Interesting fraudster stories, the witty Harry Potter reference that would have surely delighted the Potterheads amongst us, innovative ideas of keeping your credit card secure, applications of generative AI, sandbox areas for startups. Now, on behalf of entire SPJMR family, I would like to invite Nishtha to present our distinguished guests with a token of appreciation for taking time out of their busy schedules and guiding us with their valuable presence. Special thanks to the faculty members, organizing committee of Finance Conclave, and all the ones who have been directly or indirectly involved in making Finance Conclave not just a possibility, but a success. Let us have a group photograph with the entire organizing team of Finance Conclave. Let me call upon stage our esteemed faculty members from the finance field for a group photograph. Thank you so much, man.